So I think that we are ready, Niklas.
Yes.
Okay, good morning, everyone, and welcome to this joint webinar in which the new standard IFRS 18 presentation and disclosure in financial statements will be presented by the IASB with the focus on financial institutions, insurance companies, and conglomerates. My name is Niklas Grip, and I will be your moderator today. With us today is a really distinguished panel of speakers. We have a strong team from both EFRAG and the IASB and the banking and insurance industry. From the IASB, we have representation from 2 board members, Hagge Karen and Florian Esteter, and 3 members from the technical staff in the form of Nick Barlow, Ryan Hazegava, Julian Rebecca Appmeyer. We also have the opportunity to hear from the preparers representing the industry and what they focused on when reviewing the exposure draft and their final views. The strong team from the industry is Massimo Tosoni. We have from the insurance industry, we have Ricardo Sanchez Fernandez from representing EBF in this meeting. We have Ana Vidal representing a Spanish bank conglomerate, and Lemi Wong from Allianz Group, and Martin Switek from Erste Group, and from EFRAG we have Katrin Schöne. You will find the detailed background of all these speakers in the agenda, so I will not do justice to them in just summarizing their long CVs. So please have a look on there. You will also have time to ask questions in the meeting. And if you do not have an own question, don't worry, you will have the opportunity to like the questions, and then those that have the most likes will be asked during the meeting and answered by our panel members. It's a quite full agenda, wherefore I will ask all participants to be efficient and focused, as you always are. And we will kick off with the short opening sessions from the speakers. And thereafter, we will focus on the categories and subtotals, a big subject, management-defined performance measures, another big subject, and then a little bit about grouping, aggregation, disaggregation, and finally, a short session on changes in the cash flow statements, effective date, and transition. Thereafter, Katrin will conclude with the main takeaways from today's sessions. Once again, a warm welcome to everyone, and let's kick off. I think Ricardo wants to start.
Good morning, Niklas, and thank you very much, everyone, and thank you for this invitation. I'm glad to be part of this IFRS 18 seminar focused on banks, insurance, and conglomerates. I hope you can hear me well, and well, I also would like to thank the IASB and the EFRAG for the organization of this seminar. I currently, although I'm in the banking industry, I'm presenting today as representing the European Banking Federation. As a matter of fact, I chair the accounting committee at the EBF, and the project IFRS primary financial statement has been a project key for banking industry, which we have followed throughout these various phases in the accounting committee. We have even had the opportunity to discuss it with the chairman of the IASB and also with the EFRAG. From the EBF perspective, we welcome this project as a significant improvement for preparers and users. Our main comments and concerns that we had throughout the projects were very much aligned with the feedback provided by EFRAG in its comment letter. So no major difference there. So we believe that the ES board has been able to analyze in depth the concerns that were raised during the development of the project. I do not want to extend myself in this introduction, but just to give you a flavor of the topics that are relevant for the banking industry. So, as a first place, our business is a very regulated business, where we, to some extent, have the requirement to present our financial statements in a specific way with specific subtotals. So from that perspective, we welcome the relief on management performance measures, including in the standards. So we don't go through the burden of disclosing all those subtotals and with all the full disclosures. For some specific topics, we still may need to do some additional work, but I'm confident that we can overcome it, and we have plenty of time to discuss it today. It will be, firstly, the definition of a main business of activity, where in a banking industry can be some challenges because some of our members have an important insurance portion of the business model. It will also be challenging the disclosure of integral and non-integral associates. Some of them are part of the core business as well, such as joint venture, again with insurance activity. And lastly, well, as a banking industry, we would rather prefer to have interest, income, and expense within our operating profit, and this might not be the case in the subtotal of operating profits for leases or for defined benefit pension plans, for instance. Having said this, I'm confident that the standard is flexible enough to find a way around these topics, so preparers can still portray the performance of the banking institution as they intended to be. And as a last remark in this introduction opening, I just would like to take the opportunity to congratulate the IAS board for the effort on this project. I am aware that there has been a significant number of outreaches within the development of the project. The IASB has also been able to take on and analyze lots of feedback, and mostly they have been able to address most of the concerns. So clearly, congratulations, I know that. And with this brief introduction, Niklas, I give it back to you.
Thank you, Ricardo. And you also highlighted things that are warm on my heart, including all what the IASB had done in this project with outreach and so on. But Massimo, some views from the insurance industry.
Yes, thank you, Niklas, and good morning, everybody. But of course, also for the insurance industry, this is a quite relevant standard. We recently exited from the implementation of two very significant standards, IFRS 17 and IFRS 9, including also some requirements in terms of presentation. And now, of course, we have to deal with IFRS 18. First of all, I think that I welcome the efforts made by the IASB in the direction of transparency and enhanced comparability of information. But I think it's important for all stakeholders of the insurance industry to draw the attention on the fact that there are some changes that needs to be understood and to be implemented. First of all, I think that one of the area where I would expect changes is the management information that is internal and externally disclosed in terms of performance reporting. We will see during the presentation the definition of a new concept, a new subtotal, operating profit, that probably will replace or need to be reconciled with current NPM used by many insurers. And so this, for sure, it's an important area of change that needs to be addressed. I would also draw the attention around potential changes in terms of process and system because of new requirements in terms of classification. And also additional disclosure that need to be provided that for sure could be an additional cost for preparing, but at the same time, a new information for users. In terms of perspective of insurance industry, I would say that we should underline the fact that the acknowledgement of IASB of a specific business model of insurer, and as for banks, also the insurance industry has a peculiar format of profit or loss. And I think this is very positive because we had the opportunity to have a full reflection of our business model in the new structure of profit or loss. Otherwise, at the same time, it's important to pay attention to the connection between IFRS 17, our main standard for measurement, but also presentation of insurance income and expenses, and IFRS 18. And I guess that the points already mentioned by Ricardo are also relevant for insurers. So the area of attention, the area of concern in terms of practical implementation of the standard are some area on the associates, and so the topic of where to classify income and expenses for associates have been a long debate, and we will see during the presentation the final solution that have been found in the IFRS 18, but also the classification of some expenses like interest on pension and on leasing that currently are usually part of the operating results in the profit or loss of the insurers. I would pay also attention, and maybe we'll discuss during the presentation, on the new disclosure on operating expenses by nature, that also needs to be understood in the context of the already existing requirement of IFRS 17. So that's the first message from my side, and I'm glad to leave the floor to Niklas back.
Thank you, Massimo, and a lot of reflections that is similar that the banking industry has. Catherine, do you want to say something about the endorsement process and how EFRAG is taking this further?
Yes, thank you very much, Niklas. When the IASB issues, can we go to the slides, please? When the IASB issues a new IFRS accounting standard or amendments to IFRS accounting standards, the EU aims to endorse it before it comes into force. Regulation 1606 from 2002 established a specific endorsement request process where under the responsibility of the European Commission. The European Commission sent EFRAG an endorsement advice already. This happened on the 29th of April 2024. It's the normal endorsement request, so there are no additional steps to be followed. And EFRAG is planning to work on assessing the endorsement criteria over the next months, and as well to work on an impact assessment. This draft endorsement advice will be subject to a public consultation, and we expect then to finalize this process in Q2 2025 when we send the final endorsement advice to the European Commission. Just to manage your expectations, after the EFRAG process follows the process at the European Commission. This takes as well several months. There's translation necessary, submission to the European Parliament, and this has to follow as well certain periods to be assessed. And so at the end of the day, we expect an endorsement half a year, 6 months to 8 months after EFRAG has finalized its process. The endorsement criteria that we are assessing can you see on the next slide. So there are technical endorsement criteria and there are European public good criteria. The technical endorsement criteria would include relevance, reliability, including prudence, comparability, understandability, true and fair view. For the European public good criteria, the potential effects on the EU economy will be assessed. So we would compare to assess these criteria as well, how IFRS 18 interacts with the US landscape, for example. So we would make a comparison to US GAAP. Cost-benefit analysis is very important in this part as well, that we assess how costly it is to apply IFRS 18. And as I said already, we have no other criteria to assess for this standard. This is different to IFRS 16 or IFRS 17, where additional criteria had to be assessed. And one thing that I would like to mention in this regard as well, the assessment of the endorsement criteria has a different threshold compared to sending out a comment letter. So in the comment letter phase and during the redeliberation phase, we try to influence the IASB to deliver the optimal standard. When we are assessing the endorsement criteria, then we try to find out whether this is acceptable in the European environment. And so the assessment might be a bit different from what we could see in the comment letter phase. For the upcoming weeks. So on the next slide, you can see that we have already received rich feedback from you. So we have received a lot of comment letters. Thank you to all that participated in the outreach and in the field testing. And we will use these field testing results, the targeted outreach result, the technical discussions within EFRAG, to comment, to assess the endorsement criteria. And we will for sure consider the IASB mitigation, the issues that were raised. The IASB had done a lot of effort to mitigate the issues, so we will use these in the assessment process of the endorsement criteria as well. Events like today will be used to identify remaining issues for the consultation of the endorsement criteria. And as I said, we work on an impact assessment where we have a sample of different industries, and we try with a desktop approach to find out what the impact on the financial reporting of these different companies would be. With that, I would like to hand over back to you, Niklas. And I hope that I would like to say that I hope to have a very interesting discussion today, that we have more insights on assessing the endorsement criteria.
Thank you, Catherine, and thank you for the comprehensive description of the endorsement process that is quite different and unique compared to when we comment on different kind of exposure drafts. But Hagit or Florian, do you want to make a short introduction before we kick off with categories and subtotals?
Yes, definitely. Thanks a lot, Niklas. So thanks, everybody. Welcome to this session. I think before we get started, we would like to extend our thanks to EFRAG and EBF Insurance Europe, the ESBG, WSBI, EACB, all these organizations we've been working with so hard throughout this process to come up with a good solution. And thanks for putting this event together. And we're really looking forward to your input and trying to get some of these technical issues where you are experiencing in trying to implement this project out of the way this early. So this is great. Now, IFRS 18, as you know, is a huge milestone for us. It was a while in the making. It was a long journey, but I think it's the most important change to the profit and loss statement since probably the beginning, the inception of the IASB. And so therefore, I think it will bring much needed comparability to the income statements as was requested by the users along the way. So the change, if we look back how this got started, I think when we started, just go back to Mao. One more. I'll get to, yeah, fine. When we started, there was a lot of requests by users to have more comparability in the profit and loss in the income statement, because so far ISS really just required revenue and then profit before tax and net profit line. And we saw that there was a lot of differentiation in between, which was great because it gave companies the ability to present the company in the way that made most sense for them. However, if we looked at the specific what happened in there, and we did a lot of quantitative analysis at the beginning, during, and then also afterwards for our effects analysis, a lot of companies showed operating profit or EBITDA, something similar, but there was a lot of variation in how they derived that number. So although the line was named the same, the way that it was calculated was very different. And that led to a lot of confusion for users who really couldn't get to the comparability they wanted. So what we tried in this process was really to balance the different needs of our stakeholder groups. On the one hand side, we tried to increase the comparability that is shown in the statement of income of comprehensive income versus the ability of companies to present themselves in a way that is most reflective of the specifics of their business model. And so if you think about the requirements we will be talking about, think about this balancing act that we went through to find the right solution for the specific question at hand. So in the end, I think this package of requirements gives investors a better basis for analyzing and comparing companies' performance, while still maintaining, while still giving companies the ability to maintain their own presentation needs. And again, this is what we think about. It was a long process, so the requirements that we're seeing here reflect the feedback from stakeholders, from all stakeholders throughout the research project. I think you already mentioned some of the work we have done with you during the process, during the comment letter period, and also during real deliberations. And you will see that some of the mitigation effects that we put in place are a reflection of that work. And so thanks a lot for supporting us in that work. With that, let's go into the specific requirements. And we try to group them into 3 areas, so for ease of discussion. So the first set of requirement creates a structure in the statement of financial performance, and it requires companies to present 2 new defined subtotals. The structure is consistent with how investors typically analyze the statement of profit and loss, so we'll provide a consistent and comprehensive starting point for investors' analysis and hopefully help investors compare performance between companies cross-sectionally. And in particular, it is the operating profit line, which I know we will be talking about a lot today and what is above and below that operating profit line. But it was clear from the feedback from investors that that is the subtotals which we will need to define and which needs to become comparable. And so the compromise we came up with is what we think is the best idea of how to have a common understanding of what is an operating profit. Now, whilst we drive some more comparability in the income statement, the second set of requirements is intended to give companies the ability to still present the type of analysis they would like investors to see for their particular business models. Now, for European companies, this requirement isn't particularly new because obviously ESMA has put in some requirements there themselves. But what we say is, if you think the operating profit or any other line is something that reflects your specifics, your business model better, please present that to your investors. But then investors obviously would like to have a little bit of a comparison, how that compares to the presentation of the income statement as shown in the financial statements. And so this is kind of the balancing act and the way we try to give companies a way to present the best way they think about their company. Now, the third set of requirements is really an enhancement on the guidance of how to group information, also known as aggregation or disaggregation of information. We have gotten a lot of feedback from investors who said that sometimes they don't get sufficient information at a sufficiently disaggregated level. Sometimes it's too much. So I think our intent here was to help that investors receive material information that makes financial statements more understandable and useful, and to think about what sort of information should be presented in the phase in the note and which level of aggregation. We will cover some other targeted changes here, for example, to the cash flow statement later, and we'll also talk about the effective date and transition requirements. So these different areas we have small sections later on as well, but these are the big 3 requirements. So while we'll be talking about IFRS 18, and while we will be talking mainly about the statement of profit and loss, the standard will replace IAS 1. which obviously sets out requirements for many other presentation disclosure requirements in the financial statements. But many of those aspects of IAS 1 will be taken over into IFRS 18, and so they shouldn't change the requirements that we're seeing there. Because of the changes that are required, as we already heard, the system changes, the board has decided to have a fairly lengthy transition period. So the effective date will be January 2027. You will have an option to apply earlier. We obviously encourage companies to do that. But again, the lengthy transition period was a way of mitigating some of the difficulties we were told that entail the transition to this new category. Now with that, let's dig into the details, and I'd like to hand over to Rowan to take us through the categories and subtotals category. Thank you.
Thanks very much, Florian. So the requirements for subtotals and categories respond to investor feedback that it's difficult to compare financial performance between companies because the statement of profit or loss vary in content and structure. So IAS 1 requires a company to present revenue and profit or loss, but no defined subtotals in between. And as a result, varying presentations have developed. And this diversity makes it difficult for investors to analyze companies' financial performance. As Florian mentioned earlier, the effects analysis that we published with IFRS 18, we took a sample of 100 companies reporting under IFRS accounting standards. In the statement of profit or loss, we found similarities in the labels and subtotals presented, but a high degree of diversity in how those subtotals were calculated. So in a sample of 100 companies, 61 reported an operating profit subtotal, but there were at least 9 different definitions of how those operating profit subtotals had been calculated. So to address this diversity, IFRS 18 introduces 3 new defined categories to provide a consistent structure for the statement of profit or loss that aligns with how investors typically analyze the statement of profit or loss. And these categories are operating, investing, and financing. And it also introduces 2 new required subtotals of operating profit and profit before financing and income tax. To help explain the requirements for each of the categories, it's helpful to look at an illustration, which you can see on the right-hand side of the slide. This illustration is for a general corporate. Although the focus today will be on companies such as banks and insurers, it's helpful to understand the general model first and then see how it changes to ensure that these companies can report key operating performance metrics in operating profit. So the operating category is defined as the default category and includes anything that does not meet the requirements to be classified in the other categories. The subtotal operating profit will give a complete picture of a company's operations for the period. And all companies will be required to present this subtotal, so it will provide a consistent and comprehensive starting point for users' analysis. The investing category includes income and expenses from investments accounted for using the equity method, as well as income and expenses from cash and cash equivalents and other investments that investors analyze separately to a company's operations. And finally, the financing category, together with the profit before financing and income tax subtotal, will allow investors to analyze the performance of a company before the effect of its financing. So now if we look at a little bit more detail at the operating category, so as I mentioned, the operating category includes all income and expenses that are not classified in the other categories of investing, financing, income tax, or discontinued operations. It's therefore the default category that comprises all income and expenses arising from a company's operations, including volatile and unusual income and expenses. Defining operating profit in this way works well with different business models and is simpler to apply than a direct definition, which may require significant judgment to apply. And the operating category includes, but is not limited to, income and expenses from a company's main business activities. Next, we look at the investing category, which includes income and expenses from assets that generate a return individually and largely independently of the other resources held by a company. It also includes incremental expenses directly attributable to the acquisition and disposal of these assets. So, for example, transaction costs and costs to sell. And examples of such assets include rental income and remeasurements of investment properties, interest income and dividends, and fair value changes on financial assets. IFRS 18 also requires companies to classify in the investing category income and expenses from cash and cash equivalents and income and expenses from associates and joint ventures accounted for using the equity method. And there are requirements for companies such as banks and insurers to classify some of these income and expenses in the operating category, which I'll explain on a subsequent slide. But these requirements do not apply to income and expenses from associates and joint ventures accounted for using the equity method that would be classified in the investing category by all companies. So as classification of income and expenses from equity accounted investments was a topic the IASB discussed at length and consulted widely on, Florian, I'm just wondering if you would be able to talk a little bit more about why the IASB decided this classification, please.
Yes, thank you, Rowan. I think first to a certain extent, maybe it is just a misnomer to a certain extent that we say that these, non-consolidated subsidiaries, associated and joint ventures, which are accounted at equity method, are part of the investing income. We understand that these are sometimes operating companies, and they're very closely tied to the operations of the company. Right? And therefore, I think we need to, let's step back and think about it, and let's not get hung up on the fact that it's within investing or not. If you remember that in the exposure draft, we actually had a proposal in there in saying, okay, if you have these at equity accounted subsidiaries in there, let's try to differentiate which of these are really integral to your business and which of those are not. And we got a lot of feedback, and thank you for that. We had a lot of discussions. In the end, we decided against it and put all the at equity accounted associates and joint ventures below the operating profit. And there were two reasons for that. Reason number one is that in our deliberations, we were just not able to make a clear distinction of what would be within integral and what would be non-integral. And if you remember, the starting point was to increase comparability. It was clear that we couldn't use management views as a differentiation to make that distinction. So when we talked about how can we distinguish, we just couldn't find an adequate distinction. So we then decided to put it all into one line. The more important reason, though, was, and this is something I can relate to from my own personal history, is that if you are an investor, these at equity accounted associates and joint ventures are really analyzed for valuation purposes differently. They are on a net presentation, they're post-tax, they're post-financing, and so and plus you have sometimes fair value of assets effects in there. You might have deferred tax asset issues in there. So all of these different effects made it very difficult to understand that line of item as sort of a single line item within the operating profit, right? You would have different operating margins simply because you have more in associates and joint ventures and equity method, for example. From my own personal experience in the valuation manual we had in our bank, we always took those out and evaluated them separately. And this is what we heard from investors consistently. And this is why, in the end, we decided to put it directly below the operating line. And this is how you need to think about it. What we wanted to do is give investors the opportunity to say, okay, this is at equity method, and thereby we can analyze them separately. We have the line item in the other financial statements, and so we can have a look at that. To help you communicate that operating profit performance a little better, we allow a subtotal below operating profit. So it's a mouthful. You're welcome to name it something that is easier to communicate, but in the standard we call it operating profit and income and expenses from investments accounted for using the equity method, which is really a subtotal below operating profit in your income from associates. The second mitigation we give is that when you have particularly investment-focused associates and joint ventures, which are equity accounted, you can switch those to a fair value method, and then you can show them in the operating. And we find that a lot of these, when you have, particularly in the insurance industry, when you have just investments in there, that is another way of really moving in them in the operating category, because then you don't have a lot of these effects. So these were the reasons why I decided against having integral versus non-integral, and why we decided to put it as a separate line item below operating profit, and some of the mitigations we have put around that. With that, back to Ren. Thanks.
Thanks very much for that additional insight, Florian. And now I'd like to move on to the financing category, which includes income and expenses from liabilities. So IFRS 18 requires a company to distinguish between two types of liabilities: those that arise from transactions that involve only the raising of finance, and other liabilities. So to distinguish between these two types of liabilities, a company will consider what is being exchanged in the transaction. If a company receives cash and later returns cash, such with a loan contract, the transaction is a transaction that involves only the raising of finance. And if a company exchanges something else for cash, such as a lease liability that exchanges a right-of-use asset for cash, then it's an other liability. And for these liabilities that arise from transactions that involve only the raising of finance, such as the loan contract, all income and expenses from that liability, including incremental expenses on recognition and derecognition, are classified in the financing category. And as I'll explain on a subsequent slide, there are requirements for some companies to classify the income and expenses from these liabilities in the operating category. And for other liabilities, such as the lease liability, only the interest expense and the effects of changes in interest rates are classified in the financing category, and these requirements are the same for all companies. And examples of other liabilities are payables for goods and services received, decommissioning provisions, and pensions. And it's important to note that for pensions, it's the net interest expense or income on the net defined benefit liabilities or assets that would be classified in the financing category. Now, they are the principles for the general corporates, but companies we are particularly interested in today provide financing to customers or invest in assets as a main business activity. So for such companies, presenting income and expense in the way that I've just described would prevent entities from presenting key operating performance metrics in operating profit. So examples of that would be net interest income for a bank. So to address this, IFRS 18 includes requirements for such companies to classify income and expenses in the operating category that would otherwise be classified in the investing or financing category. To apply these requirements, firstly, a company is required to assess whether it has specified main business activities. And a company uses its judgment to assess whether investing in assets or providing financing to customers is a main business activity, and that assessment must be based on evidence. So in general, investing in assets or providing financing to customers is likely to be a main business activity if the company uses operating performance measures such as net interest income and net financial result as an important indicator of operating performance. And evidence that a performance measure is an important indicator of operating performance includes using such measures to communicate operating performance externally or to assess and monitor operating performance internally. And information about segments may also provide evidence that a company invests in assets or provides financing to customers as a main business activity if a company is required to apply the requirements in IFRS 8. So entities that provide financing to customers as a main business activity are required to classify in the operating category some or all of the income and expenses from liabilities that arise from transactions that involve only the raising of finance. Could we move to the next slide, please? I think we're a slide behind on the screen. Thank you. And then all income and expenses that provide So for these liabilities, all companies that provide financing to customers as a main business activity are required to classify the income and expenses from those liabilities that relate to providing financing to customers in the operating category. So that's the very left-hand box that you can see. And then for income and expenses from these liabilities that do not relate to providing financing to customers, entities have an accounting policy choice on whether to classify them in the operating or financing category. And if an entity cannot distinguish which of these liabilities relate to providing financing to customers and which do not, then it applies the accounting policy choice, which results in it classifying all income and expenses from these liabilities in the operating category. And the accounting policy choice does not apply to income and expenses from other liabilities, such as pension liabilities, which are always classified in the financing category by all entities. If we move to the next slide, so to demonstrate how these concepts work, on the left-hand side, we have a statement of profit or loss for a company that invests and provides financing to customers as a main business activity, such as an investment or retail bank. And as this company provides financing to customers as a main business activity, it includes in the operating category all income and expenses from liabilities that arise from transactions that involve only the raising of finance. And this allows the company to present its key operating profit subtotal, gross profit subtotal of net interest income in the operating category. And interest expense and the effect of changes in interest rates on other liabilities, such as pension and lease liabilities, are classified in the financing category. The company would not present the subtotal of profit before financing and income tax because presenting this subtotal would be misleading, where most of the income and expense that would otherwise be classified in the financing category has been classified in the operating category. The company illustrated also invests in financial assets as a main business activity, so income and expenses from these investments in financial assets and income and expenses from cash and cash equivalents are classified in the operating category. And all companies, as mentioned, are required to classify income and expenses from associates and joint ventures accounted for using the equity method in the investing category. On the right-hand side, we have illustrated the statement of profit or loss for an insurer that invests in assets as a main business activity. The requirements work in much the same way as the requirements for the investment and retail bank. The investment income and insurance finance income and expense, which are part of an insurer's key operating performance metric of net financial result, is classified in the operating category. However, the company illustrated does not provide financing to customers as a main business activity, so income and expenses that are bank classified in the operating category are classified in the financing category, the same as general corporates. And this company is required to present net profit before financing and income tax subtotal. So Nick, can I now hand over to you to talk us through some of the more detailed requirements, beginning with the requirements for gains and losses on derivatives?
Of course, thanks, Rowan. So we'd like to talk about a few of the proposals that are specifically applicable to financial entities, and starting with classification or gains or losses on derivatives. So on the slide here, we have a decision tree, and this have been included in along with the illustrative examples within IFRS 18 to demonstrate how we classify gains or losses on derivatives. Now, because derivatives are typically used to manage specific risks, the requirements in IFRS 18 are designed to reflect this risk management activity. So when a derivative is used to manage an identified risk, those gains and losses on the derivative are included in the same category as the income and expenses that are derived from that risk that it's being used to manage. So as an example, if we had a derivative used to manage the foreign exchange risk on a foreign currency loan, the income and expenses on the derivative would be included in that same category as the gains and losses on the FX that it's managing. So we go along the bottom of the slide on the left-hand side. So this left-hand branch of the decision tree would be the case where this derivative is in a designated hedging relationship on the bottom left. And in that case, the risk simply follows in the same way as the hedge has been designated. On the right-hand side, we have risk management where it's not within a hedging relationship. And again, the gains or loss on the derivative follow where that risk is going. Now, the only difference here is because we don't have the same rigor around identifying that risk relationship. If it would be unduly costly to identify the gains or losses that would be applicable here, an entity has the option or had to say that when it's undue cost or effort, that it can use the default category and classify the gains or losses within the operating category. So the right hand branch then of this flow chart talks about the situation where derivative is held and not used for managing risks. And so we have sort of two cases here, one where that derivative is used in the raising of financing, and one where it's a standalone derivative. So if the derivative is used related to financing, any gains or losses are included within the financing category. And if the entity provides financing to customers, then as Rowan explained, it would be eligible for that same accounting policy choice. So those are sort of the two middle boxes. And then the final case is if a derivative is held on a standalone basis, not for risk management purposes, not directly as part of financing. In that case, the default category would apply and gains or losses would be included within the operating category. So if I move on to the next, I've gone one too far. There we go. We have another decision tree now to talk about hybrid contracts. So again, I'll focus along the bottom of this decision tree here, and really that the IFRS 18 includes requirements to be clear about when we have financing or when we have a hybrid contract that is a liability, how to apply the requirements for liabilities that Rowan explained earlier. And I can't seem to get the slide to get to the right place, but that's okay. So there's sort of a few cases here. So I think it's slightly less complicated than it may seem in the flow chart, if we can get it up eventually here. But with a hybrid contract, we have there we go. A contract that's a liability with an embedded derivative. And if we go along the bottom of the slide on the left-hand side, we have the case where that derivative is separated from the host. In that case, we simply apply the classification requirements for liabilities to the standalone liability and the requirements that I've just explained for derivatives to the derivative. Now, if that if the embedded derivative is not separated from the hybrid contract, we classify the income and expenses, and that liability that is the contract itself is one of these contracts that arises only from the raising of finance, as Ron explained, as all income and expenses in those cases for liabilities that arise from transactions only for the raising of finance go into the financing category. The same would apply here, and that would be eligible for this accounting policy choice to be moved into operating when that applies. We then have the case where the embedded derivative is not separated, and it's in a contract that is not only for financing. So in these cases, there are a few different possibilities. If it was carried at amortized cost, applying IFRS 9, all of the income and expenses will go to financing. And the reason for that is to try to get away from having to separate out those changes in interest from other changes in the combined contract. And so all just go to the financing category. If it arises within an insurance contract, then it simply goes into the operating category to follow the accounting for those insurance contracts. And then finally, if we have an embedded derivative in a contract that's measured at fair value, as it's at fair value, generally there will not be interest and expenses. So all of the income and expenses from that contract will be in the operating category. A slight exception there, if there is any interest, we know in some rare cases, entities may split out an interest component that would end up in the financing category, as this is an other liability or a liability not arising from solely financing. And then finally, to just quickly touch on foreign exchange, similar to the concept that we have with risk management for derivatives. With foreign exchange, the requirements are for that gain or loss from the foreign exchange differences to be included in the same category as the other income and expenses from the underlying asset or liability. So for some examples, if we had receivables for the sale of goods, any foreign exchange differences on those receivables would go into operating, similar to the other income and expenses from that. Similar to if there was cash and cash equivalents, having income and expenses from those being classified in the investing category, any foreign exchange differences would equally be included in the investing category. And of course, those same policy choices to move these income along with the related income and expenses for those assets or liabilities into operating when that applies would apply with the foreign exchange as well. So that we've covered quite a lot of ground there. Before we turn it back over for questions, I wanted to ask Hagit to provide some sort of final thoughts on subtotals and categories from the board's perspective.
Thank you, Nick, and thank you, Ron, as well, and Nick especially for explaining hybrid contracts with the slide keep moving. That was a challenge. So from the board perspective, I think this is a meaningful change, and we truly believe in this change within IFRS 18 about the change in structure and the subtotals, but we know very much aware of the cost that this will entail. So it might be that it might be more complex or less complex to different companies, but for those that will need to deal with this, it's going to be a challenge. It's going to be costly. It might be that you need to do your remapping of your accounts to the chart of account in certain circumstances, and we know that this is every time you deal with systems, it is complex. It might be that the processes will need to change because of that. It might be that the internal communication will need to be different once you identify your subtotals a bit differently. It might be, or it's quite certain, it's going to be different in the terms of communicating the information between the company and investors. There would be education as well in this process. So it is a challenge, and we very much appreciate this. But we believe still that the benefits overcome those costs. What we provide with this section of the requirements is really a single focal point for investors to start their analysis, but actually it is for a good communication between companies and their investors. They look at the subtotal and they both know the rules of the game. They know what is inside and what is not there. This is a very good start of communication. And I think in addition to that, adding comparability and transparency to the market in this area is very important. So acknowledging the big effort and the challenge in the transition, but still we believe truly this is a meaningful change, and it will provide better information to users and better communication between companies and their investors. Thank you.
Thank you all for this really comprehensive and clear description. Please, audience, join slido.com and ask questions, and we will try to answer as many as possible. And please, those that do not ask questions, please like the questions you like, so to have the possibility to have the most relevant question raised. But before that, I would like to hear some comments from the industry, and let's kick off with the insurance industry and Laimi. What's your reflections?
Yes, hi. Thank you for having me here. So I'm happy to share some views from what we have seen during the exposure draft feedback commentary period. So for us, one main thing that we have brought up a couple of times is relating to the share of income and expenses from investments accounted from investments in associates and joint ventures accounted for using the equity method. So we know that from the exposure draft to now to the actual IFRS 18, there has been some welcome changes in that the distinction between integral and non-integral investments in such areas is not required anymore. So that's a welcome change. But the requirement in the end to require such income and expenses to be presented in the investing category is actually still not 100%. Still not 100% really like that we see as optimal for the insurance industry. So I also hear that we have the option to make the election to change the accounting to fair value through P&L upon transition to IFRS 18 for such investments. But we also do not necessarily want to make this change, using this method for the purpose of the accounting, for the purpose of the accounting mismatches, where we only want to do that for the contracts with participating discretionary features. So that's what we have seen from our point so far. So I think for this part, we still have a difference of opinions between what we see as optimal. So we also see that, if to address this, perhaps, we could include that line in the operating category instead, but showing it separately so that in the end, we could still have an operating profit that includes this. And it's up to the educated investors to be able to separate that. So we actually see that would be actually and also an acceptable alternative. But I think with that said, I will leave this point as is for now. So yeah, this is what we have seen. Thank you.
Thank you, Lemi, for this. And yeah, let's stress on with Massimo, please. Some comments from your side as well.
Thank you. First of all, I agree with what Lemi said. So this is one of the points that was mainly discussed during the exposure draft and during the interaction with the IASB. Another area of concern of current analysis I would like to highlight is what we shared also at the beginning of the call. So now in the profit and loss, we have the interest expense related to IAS 18 and IFRS 16 part of the financing category. And this, of course, is in general a change compared to the current practice of insurers, where these expenses are normally part of the operating result. But I guess that an area that needs to be further analyzed is the connection with the IFRS 17 requirements. In the implementation of IFRS 17, preparers needs to work with the concept of attributable expenses, and in contrast, many contracts in long-term contracts, part of the pension cost or the leasing cost have been attributed to the insurance contract, and so are presented as part of the cash flows, including in the current fulfillment cash flow of insurance contracts. And so it happens many times that the pension cost, including also its unwinding, is currently part of the projections of the cost, and so it's already included in the insurance service or finance expense as part of the insurance service result of the finance result. Now, of course, we have to cope with the requirements coming from IFRS 18 to strip out the interest expense and to include it in the finance category. And so this is currently sees a sort of conflict with the implementation that many preparers followed in the concept of attributable expenses under IFRS 17. For sure, maybe the practice is not the same for all the industry, but this is an area that needs to be further analyzed to understand if the requirements can be considered as relevant only for the part of the pension costs that are not currently attributable to insurance contracts or not. And so this is an area that needs to be further investigated. Of course, as I said, it's in general a difference that we see from the definition of the operating profit that is currently under the NPM of insurers and the new operating profit of IASB. And so we need and this would be very likely an area of reconciliation between the two standards. But this for sure is an additional area in the topic of subcategory that need to be further analyzed and see how in practice we can find some viable solution in order to apply at the same time consistently IFRS 17 and its definition of expenses and IFRS 18 with the new classification requirements in the format of the profit or loss. Niklas, back to you.
Thank you, Massimo. Let's then hear from the banking industry that partly also, of course, have some insurance. But we start with Anna. Welcome.
Yes, thank you, Niklas, and good morning, everyone. It's a pleasure to participate in this educational session, and in this case, to share CaixaBank's experience. We are a financial conglomerate on how we intend to apply IFRS 18 and some of the questions that we are currently discussing in the context of applying the standard. On this fifth section on categories and subtotals, we welcome the accounting policy choice that the IASB has made available for banks and insurers to combine the financing and investing category for almost all income and expenses and under the operating category. And in our company, we have been following very closely all the discussions that the IASB has taken after the publication of the ED. We appreciate that the IASB has considered the feedback of the industry to a large extent throughout all this process, which also included a field test with a group of companies. And overall, we believe that the IASB has reached the right balance in many topics, but as it happens with some other standards, some concerns may have not been addressed, as some of my previous colleagues have highlighted. And in this case, from the perspective of the financial conglomerates, one concern relates to the presentation of the statement of profit and loss. As Massimo was explaining, last year, financial conglomerates, we applied IFRS 17 for first time in our insurance business. And also, in most cases, we were also applying for first time IFRS 9 in our in the portfolio of assets that were supporting this insurance business. And we have seen, based on the last year financial statements, that there is diversity in practice on how financial conglomerates prepare and present its statement of profit and loss. And we question whether IFRS 18 will improve this comparability of information for financial conglomerates. It was very useful, the slide that you were commenting on for that was displaying the profit or loss for banks and for insurers in, I think it's slide 22, but we are unsure whether it will be as easier as adding the two standalone structures for banks and insurers, whether this summing these two structures will be the way we need to provide our statement of profit or loss for financial conglomerates. And when you have two main activities, some questions arise when you are applying the requirements in practice. For example, if I may raise some questions, if we assume in a hypothetical scenario where we consider that the banking business only has as a main activity providing financing to customers, and in the insurance business, the subsidiaries they only invest as a main activity, we ask themselves, for example, whether at consolidated level of the conglomerate, the funding that maybe the insurance business is receiving from external providers could be presented within the operating category if we say that the insurance business only invests as the main activity. This was one point. We are also looking for clarity, and this educational session could be a good place on how to assess which assets of each business cannot be classified in the operating category. And also it will be very helpful to have your view on in which cases do you expect that banks will conclude on a standalone basis that they only have one main activity. That I believe this was also a point that Nicholas was mentioning in the introduction, because all these questions, it may have consequences at consolidated level, but also when we prepare the separate financial statements. And I will stop here.
Thank you, Anna. Thank you very much. Martin, please, could I have your view, please?
Thank you, Niklas. Erste Group is a bank, not a financial conglomerate. And we invest and provide funding to customers as our main activities. So in this specific situation, almost all of our income and expenses end up in the operating category. So our operating profit subtotal is usually very close to the total profit or loss. The items under the operating profit are usually less than 1% of our total profit or loss, because we have just minor investments in associates and joint ventures, and also interest expenses on the pension liabilities and on lease liabilities. They are not that significant in our business. So in this situation, when operating profit is very close to the total profit or loss, it is questionable whether such a operating profit or loss subtotal should be presented. This is a mandatory subtotal. So from this perspective, we understand that there would be difficult to avoid its presentation. But what we have under the operating profit subtotal, these remaining lines, associates and joint ventures, and interest expenses on pension and lease liabilities, we still consider them to be part of our operating performance. So from this perspective, the operating profit subtotal does not add much added value to the structure of our income statement, and we consider that we would be better off if we could avoid its presentation and could just disclose somewhere prominently in the notes what this operating profit is. When saying this, we understand the requirements for structuring the statement of profit or loss, and we understand that it brings much added value for other kinds of businesses or for other entities. Just we are in such a specific situation when we don't consider that this new subtotal brings some added value, because it clashes also with what we see as our operating performance. For a long time, we have been publishing our operating result as our management performance measures, and there are similarities in these two terms: operating profit as being required as the mandatory subtotal, and what we present publicly as our MPM operating result. And in this specific situation, when this operating profit gets so much prominence directly in the profit or loss statement, we may even need to reconsider renaming of our operating result, which we have been communicating for a long time. And in this case, however, I would say that due to our specific situation, that almost everything is in the operating category, the guidance for classifying income and expenses on derivatives, on hybrid contracts is quite easy to apply. So at least in that situation where other entities face complex issues, yeah, we are not confronted with such a situation, because all such gains or losses on derivatives or income and expenses on hybrid contracts, they will naturally end up in that operating category.
Thank you, Martin. You highlighted there in the end something that is quite specific also for our bank. We have one corporate goal return on equity based on operating profit, and now the definition of operating profit will change. So it will be attention for us in the implementation. But last but not least, Ricardo, the view from the banking industry. Try to summarize all our points here.
It's going to be a remark more than anything, because much of the topics that I had in my introduction have been discussed by my colleagues already. So just to echo a little bit, associates, it is quite common for a banking business model to have joint ventures with other service providers, such as insurance, but not only. And in these joint ventures, basically what we do is we find a more efficient structure to deliver a service to our customers without having to build the infrastructure ourselves. We consider this part of our operating profit. That's how we present it with investors. Obviously, by the reasons discussed by Florian, this was decided to be kept in the investment category, which eventually means that in our management report, our results presentation, we will have to tackle this through disclosure on management performance measures, summarizing the profit. Otherwise, we would have to explain to the market why that operating profit has moved so much. Also, having interest and expense outside of NII, even it's for other liabilities, it's going to be something that has to be explained depending on the impact of each bank. But obviously, it's something that you already had there, and now it's going to be in the funding category. So again, that will be something that has to be explained to the market. And just finally, my remark on the main business activity, which my colleague Anna discussed earlier. So it is true that in the banking industry, we may, not only if you're a conglomerate, but a normal banking institution may have a significant business activity relating, for example, to insurance. And obviously, this is something that probably needs to be tackled, or at least provided some additional guidance as to how we decide which is the main business activity. Obviously, we be a banking activity, but again, to what extent, if insurance activity within the business model have a significant weight in the profit and loss, how we present that to the market. So maybe guidance there will be welcome. And that's from my side. Nicholas, back to you.
Thank you very much, Ricardo. It was some questions raised to the IASB here during the Q&A session. So anyone from board or technical staff that want to comment on any specific ones?
Yeah, let me tackle a few comments, and then I'll hand to Hargeet and the technical team. The topic that was raised on the associates and joint venture. The reason why we decided to take them below operating profit was not the fact that we think those are all investing or these are not part of your operating business. The reason why we mainly decided to put them below operating profit was the measurement model. The equity measurement model, with all its quirks, and we do have an upcoming exposure draft on this one, but the equity measurement model takes a different valuation approach than the full consolidation or fair value that we have within the operating model. And that was the feedback we got from investors all the time, that these investments are treated differently because of the measurement model, not because of the question, is this part of your operating business or not? That was the main reason why we took them below the operating profit. Still can present it there. You cannot move it above the operating line. You can do that for your MPM, but surely not in the face of the financial statement. The second line, this was on Martin, on sort of the operating profit line. So the intent of this was to provide comparability on operating profit, so that when an investor looks at the face of the profit and loss statement, there's an operating profit line which is comparable across all entities. And so this is why we require this in there. If you have below a few certain items, and if you have tax, surely you have taxes below, so we can have that separate. but we insist on this one solely to increase the comparability across companies. That would have been my comments. Anybody want to pick up, Hargit? You want to do the pension leasing cost topic?
Yeah. Thank you. Happy to do that. So I think in terms of the interest component that goes to financing, I can truly understand why both in the banking and the insurance industry, you see this component as part of your operating, and you've seen it today. But you need to remember that when we came to make decisions, we needed to look at the outcome at the end and whether we add complexity by accommodating different needs of different industries. And I think you can acknowledge we went a long way to accommodate the way that insurers and banks look at their business. The whole idea of main business activity was developed in order to accommodate the way that banks and insurers look at themselves. The work around derivatives also reflect that. But when we got to other topics as well, we needed sometimes to make a decision based on not adding additional complexity to accommodate specific needs. And here the decision is that the interest component of the pension liability of leases will be in financing. I can understand why it's not natural, because your perspective is a bit different. I think you can accommodate this by using MPMs. But you need to realize, and I learn it on the job all the time, sometimes we need to make compromises in order not to make the standard so complex that it's not operational to everyone else. So I think that's my addition on this one. And it applies also to the associates and joint venture. And I have to admit as well, I know it from the insurance industry more closely. Sometimes the associates are just part of your portfolio of investments. I'm not talking about the situation when they are your long arm. And we had to make a call on this one. And the feedback that we got was very, very clear. And we had to work with this. So I think Florian covered this well as well. Hand over maybe to the team if there are other things that you want to reflect upon.
We had the 18-17 interactions.
Yeah.
Since you're our 17.
Yeah, I can relate to this as well. So I think one thing that is very important to note, IFRS 18 is not going to change recognition and measurement in other standards. That's not going to happen. That's not the intention. It's not happening. IFRS 17 accounting remains the same. IFRS 17 accounts for revenue recognition. The fact that we include in the expectation of cash flows different components, including the unwinding of interest, is because we want to have revenue allocation being allocated to periods over time in a meaningful way. But I do accept the disappointment to some extent, because insurers have done a lot of work in moving to IFRS 17, have a good understanding of what's coming to revenue and a good understanding of what they consider to be the cost. So I agree that that component of unwinding, that if it is included by some insurers in the insurance liability, would be released to revenue in terms of your IFRS 17 accounting, but the actual expense will be in financing. I think I gave a bit of a background of why we had to come to this conclusion. I do not see it as a conflict, but I do understand the disappointment or the expectation gap in this point. And I think maybe to the extent that it is something that is material, MPMs could be useful here as well. Did I miss anything else?
Thank you. You have commented on most of the questions that actually have been raised in the Slido chat already without me needing to ask them. So thank you for the efficiency there. But we have one other question that we have time for, and it's discontinued operations. It's not mentioned anywhere in the slides and so on. And for a bank or insurance company, where should discontinued operations be placed in the new income statement?
Okay, so I can pick up that question. The discontinued operations will be a separate category at the bottom of the statement of profit or loss. So it's very, very similar to what we have today. It wasn't illustrated in the slides, but in the supporting materials, illustrative examples that we put out with IFRS 18, you would be able to see that illustrated.
Thank you. We take one final question, and that's actually to the panel members, and I don't have the answer, and I need to see if the others have. It's actually about regulatory reporting. It's the FINREP reporting. It may be some kind of conflicts between the FINREP reporting and this new income statement. Have anyone reflected on how that should be resolved? Anyone? Yeah, Ricardo?
Yeah, I can. If you want, I can take that one. Well, as for most of you know, being regulated, we are required to submit supervisory reporting. One of them is a financial reporting based on accounting, which is called FINREP, as you mentioned, Niklas, and the accounting standard on which FINREP is based is IFRS. Not all banks apply IFRS, so there's specific classification for non-GAAP preparers. But in any case, yes, we apply IFRS. Now, I don't see an immediate need of changing the supervisory reported from an accounting perspective. Clearly, and it's a remark I was going to make in the next section. Probably I'll introduce it now and save it later. We operate in different jurisdictions across Europe, and in some of those jurisdictions, regulators have explicit formats and labels and subtotals for primary financial statements, which obviously will need to be changed for IFRS preparers. That the decision of changing FINREP, the supervisory reporting, will be based on the assessment that the European Banking Authority makes. However, I don't see it something that is I don't see it something immediate, because most of the supervisory analysis, metrics, ratios, and so on are based on current FINREP standards. So they have no obligations to change this. Obviously, they will have to make some adjustments. But I don't think they will engage into that process until a much later stage. So they could change, but they don't really have to.
Thank you, Ricardo. It is, as always, I know that like the SME definition, it's 8 different ones that we need to manage in different kinds of regulatory reporting and so on. So it's something to solve in the detailed implementation. But thank you, everyone, for this session. But let's move on to management-defined performance measures. Who will kick off from the IASB?
That will be me.
Thank you, Nick.
So yes, if we continue on with management-defined performance measures, so where we talked about the subtotals and the categories giving a comparable structure to the statement of profit or loss, MPMs are where companies have the opportunity to provide more company-specific information about how management views the company's performance. Now, we know today, particularly in Europe, many companies are using what we term here alternative performance measures to communicate their views of performance to investors. And the message that the IASB heard from investors was that information is very useful to them. But they said when they're getting information about company-specific measures, it's extremely important for that information to be transparent, both about what it's being used for, how it's being calculated, and also it's important for them to understand how those measures then relate to the IFRS accounting standard subtotals that are being presented, and also to understand, when there are changes being made, why are those changes being made, and what are the effects of those changes. So it's important in this case to highlight that MPMs will be a specific set of measures that are related to the statement of financial performance. And I'll talk a little bit more in a minute about the specific definition of an MPM. But on the right-hand side of this slide, we can see that there are examples of some of the most commonly used non-GAAP measures that we see today and how they relate to the MPM proposals. So as I said, MPMs relate to the statement of performance, and so those kinds of measures, such as adjusted operating profit or an adjusted operating profit. So again, those things that are derived from the statement of profit or loss will be within the scope of these requirements for management-defined performance measures. While those measures that are not, so maybe based on a cash flow statement or balance sheet measures or potentially ratios, would not be NPMs. And so some examples of that would be something like a free cash flow measure or return on equity. So if we get into more details of the definition itself, where there's three components to the definition. So the first is that management-defined performance measures are subtotals of income and expenses. So this is the part of the definition that anchors those NPMs to the subtotals that are defined in IFRS accounting standards. And so this would include subtotals that are included within a ratio. So I know I just mentioned that ratios specifically would not be a part of a management-defined performance measure. But one of the changes from the exposure draft to the final standard was to avoid this situation where an entity could sort of use a subtotal and then simply put that into a ratio and then no longer have it be a management-defined performance measure. If we had something like the return on equity ratio that we saw in the last slide, and that return component was based on something, say, adjusted operating profit, that adjusted operating profit would still continue to be an NPM even though it's been used within a ratio. But important to understand that that ratio itself would not be an NPM, and so it would only be the subtotal itself. So that's the subtotals. The second part of the definition is that it's used in public communications outside of the financial statements. And so here, the idea is really to not create a new set of measures that just for the purposes of these requirements. It's really to try and capture things that companies are using today. They're out there in their public communications, and if it's one of these subtotals, then it would be captured within the definition and required to be included within the financial statements with the requisite disclosures. And then we have this final piece of the definition, which is about demonstrating or communicating, management's view of the company's performance. And so this is very much one of the things that investors said they were very much interested in understanding. How does management see the performance of the entity? And so this is part directly of the definition. Now, there's a potential slight conflict between public communications and management's view. And so to resolve that, what the standard does is makes this assumption or presumption that if a measure is communicated in the outside the financial statements and it's one of these subtotals, it's assumed that it's been put in those public communications for the purpose of communicating management's view. Now, there's a recognition that in some cases, and we talked a little bit already about regulatory requirements, that companies put out measures for reasons other than communicating their view. Regulatory is one of them. Perhaps there's significant requests from stakeholders, but it's not something that management uses internally. So in these cases, the standard has requirements that allow a company to rebut that presumption. So it needs to have evidence that demonstrates that it has communicated one of these measures for a reason other than communicating its view, and that it doesn't in fact communicate its view. So that might be something like using the measure in a way that's consistent with that. So not providing significant analysis around this measure would be one way to do that. And if it can demonstrate both of these, such a measure would not be a management-defined performance measure. So we talk a little bit about the disclosure requirements. So as I said, once we have identified a management-defined performance measure, the standard requires that measure to be disclosed within the financial statements. All of the management-defined performance measures need to be included within a single note to the financial statements. That makes it easier for investors to find that information, but also makes it so that all of the information required to understand the measure is disclosed together with those measures. Then we have the key parts of the disclosure that would be required are very familiar to those of us here in Europe. The first would be a reconciliation back to the most directly comparable IFRS defined subtotal, an explanation of why that NPM has been reported. So what is it used for? What information is it trying to portray? An explanation of how the management defined performance measure has been calculated, and then explanations of changes to management defined performance measures. And so that would include explaining why a measure has changed when that's the case, what the specific change is, and also including comparative information. I have a relatively simplified example to demonstrate a couple of the more detailed aspects of the requirements. One of those is to link the reconciling items to the items within the statement of profit or loss. So in this example, we've presented the reconciliation in a columnar format. So we have the adjustments of impairment losses, restructuring, and gains on disposal of PP&E. And we can see in each of the columns how those adjustments then relate back to each of the line items within the statement of profit or loss. Another key part of the requirements is, and something that is probably the most different to those reporting under the APM guidelines in Europe, would be a requirement to disclose the tax impact and the NCI on each of the adjusting measures. And so we can see those displayed in rows under each of the relevant adjusting columns. So that's what we wanted to cover today with NPMs. I will maybe again turn it back to Hagit to get some views from the board's perspective on NPMs and the benefits there.
Thank you, Nick. So as a board, I think this is one of the areas that we got a lot of support, both from users and from preparers. From the preparers' point of view, this is not requiring a preparer to do something that they haven't done for managing their business. So it's leveraging on existing information, and the rules of the game on how you disclose your adjustment are clear. So they are clear for each preparer and to the industry that they work with. So it allows comparability for them as well. From the user perspective, I think the additional benefit of transparency and again understanding the rule of the game of how you disclose where the information is also the comparability and the rigor and the comfort that users have from having information being included or disclosed in the financial statements that goes through the whole process and controls and audit as well. So it's adding a lot of confidence to the market in this important communication. So I think from the board perspective, this was very much welcomed, and we were very appreciative of the feedback that helped us refine the requirements and to get to something that is generally very much acceptable. Thank you.
Thank you a lot. Then some reflections and questions from the panel. Should we start with you again, Lemmy?
Sure. So regarding NPMs, so during the exposure draft period, we already welcomed this proposal because we see that it's useful to have more disclosures and information about all these NPMs that all the different companies are presenting in their financial statements. So I think that's a general welcome thing for in general for all. I think for us from the exposure draft to the final standard, the change that was made as well was that was another welcome change was the simplified approach allowed for the presentation of the income tax effects. We think that that's also something that would certainly simplify the process of presenting this information. However, another point that we see that could present some implementation challenges or that we need to look further into is the effect on the NCIs, the non-controlling interests, especially for huge organizations. There's so many holdings with complex shareholdings on top of shareholdings. So then that's something that we would need to look into to see how to actually make it workable to extract the information in an auditable way. So I think that's something that would certainly need some more efforts. So this is just a comment from my side.
Thank you very much, and I really agree with your comments as well. It's relevant for us as well. Martin, any comments from your side?
Yeah, we fully understand the merit of these reconciliations between the management-defined performance measures and the closest subtotal. In the commenting process, we had some reservations or serious reservations against this NCI and income tax effects disclosures for each reconciling line item, because we have never been asked for this kind of information by our users, but we also understand that the IASB received different feedback from entities, and that many users highlighted the need for such an information. We appreciate the simplifications which was provided in the final text of IFRS 18, that the tax effects could be just calculated simply by multiplying the reconciling line item at the statutory tax rate in that jurisdiction. However, for non-controlling interests, there is no simplification provided, so yeah, we have to go for a fully fledged calculation, and we have to even adjust our consolidation system in this regard to prepare this information, because we have significant non-controlling interests in our business.
Thanks a lot, Martin. Anna, any comments or reflections from your side?
Yes, just a short comment. In our group, we have performed a high-level review of all the KPIs that were disclosed in our public information for the last year end. And we feel quite comfortable because we have identified less than 10 MPMs. So we will need to provide the reconciliations in the notes for these MPMs when this standard comes into force. And one concern that we raised when we had the field test phase was that users may assume that these identified KPIs are the most relevant to explain the performance of our business. However, we believe that for these less than 10 MPMs, we will explain in our notes that these are the MPMs that meet the IFRS 18 definition. So they are not a complete picture of our performance. When we were conducting this high-level review, one question that was raising with us was that when we are adding specific subtotals that they could be subtotals that they were included, for example, in slide 22, when we are defining, for example, income from services, and we are adding the fee and commissions income and expenses, and also the insurance service result, which is quite a frequent KPI from a financial conglomerate. We weren't sure whether when adding these subtotals, they will meet the MPM definition of the IASB. And if that was the case, whether it will be necessary to disclose the tax and the non-controlling interest effects. And that's our experience. Thank you.
Thank you, Anna. And I just kind of want to comment also on the question you raised, because I'm a little bit unclear, and I'm happy to hear the IASB afterwards, because I follow the IASB monthly papers, staff papers, and so on, where it's a comment on if you just have an extra summary. Is that an MPM, even though it's readable from the income statement? So you can comment on that later on, because it's unclear for me still how to read the standard. But Ricardo, some views from your side.
Yeah, thank you, Nicholas. Well, MPMs is not something new. We already had them, and we were supposed to some extent, specifically in banking industry, when you present a specific metric, you are supposed to disclose how you are calculating. Now what we have is a clear link between that metric, that MPM, and the financial statements, which is, I think, is very appropriate. I guess the main concern from banking instances, and it's one of the main feedback we provided the board, is that being a regulated business, in most of the jurisdictions we operate in, the regulator has some sort of format for our primary financial statements, which includes additional totals, subtotals, or specific disclosures, which are predefined in a regulation. And obviously, going through the burden of all the disclosures and the process that Nick described would have been messy, cost ineffective, and obviously would have increased the pages of our financial statements to something that is not relevant. Thankfully, and it's very much appreciated, the relief Nick mentioned in his presentation is going to allow us not to treat these metrics, these regulatory metrics, as management performance measures, which is very welcome. Obviously, there will still be some reference and explanations in our presentations to the public. A different matter is what I introduced earlier about the supervisory financial reporting, which eventually, I believe, in most jurisdictions, regulators will do some sort of mapping between the proposed format of the public financial statements aligned with IFRS 18 and the existing supervisory reporting based on FinRep. Obviously, this will make some sort of easier to make these disclosures on MPMs, but we'll have to wait for that. So I think the message here is this is going to trigger regulators to change the format of public financial statements, where they impose a specific format, and they will kick off their process to make these amendments as soon as the standard is finalized and is endorsed. So I guess the message here is that we need, from now, a speedy process for the endorsement, which is my main remark, Nicholas.
Thank you, Ricardo. And just a reminder to the audience, please ask questions in Slido, and we'll try to answer as many as possible. But before we go to the questions, any comments from the IASB side on the different questions raised here?
Yeah, let me start off with the tax and NCI requirement. The reason why we put the tax and NCI requirement, which obviously goes beyond the what you would normally present under the ESMA requirement, is to give investors the opportunity or the ability to make up their own minds of what they think the best valuation line item or subtotal is, right? So we appreciate that the operating profit gives comparability, but probably is not best reflective of the specific business. The MPMs is management views of what is the best reflection of the business model. Now, investors' view is most of the time somewhere in between. And we want to enable investors to sort of calculate their own best view of how to track your business. And for that, obviously, that is always after tax and always after taking out the NCI effects. And the problem with the NCI effects is, as you know, they actually differ quite a lot between the different line items depending on the profitability of your specific subsidiaries. And so this was the reason why we put these two requirements in there, so that investors can make up their own minds between management views and the highly comparable operating. And I'll hand over to Hagit to talk about sort of the subtotal versus MPM discussion.
Yeah, happy to do that. Thanks, Florian. So there was a question that was raised. So if we have on the face of the P&L subtotal, just summarize two line items, is it an MPM or not? And the question is whether it meets the definition to provide this disclosure. So the fact that a subtotal or an amount appears on the face of the P&L does not exempt it from being an MPM. We need to go through all the MPM requirements and see if that subtotal meets the definition of an MPM. We were quite aware of this, and there is a list in IFRS 18 of specified subtotals that we know that are commonly used to provide useful information, and those are exempt from the MPM disclosure, but others that are not listed there, if they meet all the conditions, there would be an MPM and a disclosure would be required, and the additional benefit of seeing the tax impacts in NCI is something that is useful, as Flo just said. So it does not provide exemption. You need to look at what it is that you provide. You need to go to the MPM's requirement, have a look at the list of the specified subtotals that are exempt from this disclosure before you make your decision. Thank you. And I think maybe I'm moving this to the staff to see whether there are other questions that we want to address.
No one from staff that want to address?
Yeah, sorry, I was just going to say, I think just finding the mic there. I think we've covered everything that was brought up in the discussion, but I imagine there's questions from the chat as well that we want to address.
Yes, they're quite similar, but not exactly the same as you have commented on. Like if you, because perhaps I could answer one. If I say that I don't have an MPMs, I don't need to disclose that. But I think that was answered quite clearly. That look into the list of things that are considered to be kind of MPMs that IASB is aware of, then it's not MPMs. But if you invent one, my example is for example, net interest income after credit losses. That is not defined. So even though it's quite clear from the income statement what it is, we need to make that disclosure, and it adds some more for us that we need to cut down. But it's not that complicated. It's more kind of add to a little bit of clutter. One question that was not included there, could you just put in an extra number in the income statement that is kind of an MPM and it's not defined? Is it allowed to have kind of extra figures in the income statement, or are you kind of, do you need to present that outside of the income statement? Do you understand the question? Say that you extracted from five different numbers into one number that is not displayed. Can you do that?
Well, so I suppose it depends what we mean by extra figures. But IFRS 18 does include some specific requirements about when you can put in additional line items, when you put in additional subtotals, and some guidelines around, it needs to be something that's calculated in accordance with IFRS accounting standards. It needs to fit that structure that we've explained, so things can't move around in categories if it's operating, it needs to stay in operating, for example. But as long as it fits that structure, it's calculated in accordance with IFRS standards. We'll talk a little bit about disaggregation and the concept of a useful structured summary, but that's just talking about the level of aggregation within the statement of profit or loss. As long as these are being respected, there's no specific prohibitions on anything. A disaggregation is permitted if that's seen to provide useful information. An additional subtotal, if it fits that structure, is permitted. And then keeping in mind the answer to the previous question that subtotal, if you put in an additional subtotal, could be a management defined performance measure if it meets those other aspects of the definition and isn't defined. So I think just some things to keep in mind there.
Thank you. We have one question that have not been commented on, and it's a possible interaction with IFRS 8. Are there any needs to make changes in IFRS 8 due to the new structure in IFRS 18? ?
So we don't think there are. We think so. There is within 18 some additional clarity, because there can be overlap. We see that a measure for under IFRS 8 could be a management defined performance measure when we look at it at the entity level. What IFRS 18 does is then provides a bit of guidance. Say if that happens, you have a couple of options, because we have this requirement to have a single note. So you can either just have that in both places with the relevant disclosures in each of those notes, or you could combine those notes together, just being clear about which information meets which requirements. And that's really just about making sure that MPM information is all within the single note.
Thank you. We have a little bit of time, so it's one question that really is for the previous session, and it's about conglomerates or financial conglomerates. And I think it's related to kind of, could you have several main businesses ? So if you take the example of a bank that owns a big insurance business as well, how do you present that in the income statement when it's both? And to make a more detailed and complex question, say that an insurance company 100% invest in assets issued by the parent. How do you divide income from those instruments between the different categories, or should you just eliminate them in the income statement and you will not have the true reflection of the insurance business in that case, and so on? More flavor about how do you come up with the structure of an income statement in financial conglomerate with say 50-50 banking and insurance business.
So I can pick that up, and then if necessary, the rest of the IASB side can jump in. But first and foremost, there's not a requirement to have a single main business activity. So of course, an entity can invest and provide financing, have both those main business activities. It's not a case of the requirements don't work, that you have to determine which is the most important, and that's the only one that goes into operating. Both, if both activities are important, then both would be reflected in the operating category. Obviously, later in the session, we will talk a little bit more about the concept of useful structured summary, which is how an entity, it's a new concept based on the role of the primary financial statements. I won't go into a lot of detail because Juliana will be talking a little bit about that in the section on aggregation and disaggregation. But in terms of the line items presented, the entity would then determine which line items provide the useful structured summary. So, for example, in our illustrative examples, we provided an illustrative example for a bank. We also provide an illustrative example for an insurer, and there's particular line items and subtotals similar to gross profit that are illustrated in those examples. If you're a company that is, or a conglomerate that is doing both of those activities, then you may like to consider to provide a useful structure summary presenting a combination of those line items. It's a little bit difficult to comment on individual circumstances or in which situations which line items would be presented, because it's obviously very entity specific and something that an entity will do to provide the most useful information to their users of financial statements. But within the operating category itself, Juliana will talk more about this. You either present line items by nature or function. So within those requirements, you would then present the line items that reflect the circumstances of the entity. In terms of assessing which assets should be reflected in the operating category versus which assets should be presented in the investing category, it's an individual asset is the unit of account that can be used, but entities are permitted to perform that assessment for groups of assets with similar characteristics. So, for example, investment properties, you could assess all investment properties in one assessment, or all debt instruments or equity instruments in a single assessment, but you would not then assess all of those together as one assessment. Just in terms of line item presentation between those which are so insurance related and banking related, and maybe there's some intercompany transactions going on around that, I think it's very much up to the entity to determine how to eliminate and present those line items faithfully to represent its activities. But I'm not sure if Hagit or Florian would like to add, or Nick, you'd like to add in anything more to what I've said.
And thank you. Are there any other questions or comments? Else we can move on to grouping, aggregation and disaggregation of information.
Thank you, Nicholas. So now let's move on to the final set of main requirements in IFRS 18 around grouping of information, or aggregation and disaggregation. So if we could move to slide 36, please. The message that we got from investors was that often information in financial statement isn't quite grouped at the right level to provide the most useful information. And some companies don't provide enough detailed information about important transactions. So, for example, there are often large balances labeled as other. And in other cases, there is excessive information about unimportant transactions, which can then obscure the information that investors are looking for. IFRS 18 responds to these concerns by introducing guidance to help companies judge the level of grouping that is appropriate for their circumstances. And this includes guidance on whether information should be presented in the primary financial statements or disclosed in the notes. But it also includes enhanced requirements for grouping items, including requirements for presenting and disclosing operating expenses and disclosures about items labeled as other. So on the next slide, we can see one of the ways IFRS 18 aims to improve aggregation and disaggregation of information, which is to define the roles of the primary financial statements and the notes. And as we've discussed earlier in relation to when additional subtotals are required, IFRS 18 defines the role of the primary financial statements as to provide a structured summary of a company's assets, liabilities, and equity, or income and expenses, or cash flows, which is then useful for three things. First of all, for obtaining an understandable overview of those items, but also to make comparisons between companies and between periods. And last but not least, to identify items or areas which investors might wish to seek additional information on in the notes. Now, this concept of a useful structured summary will help companies decide which information to present in the primary financial statements and which information to disclose in the notes. Importantly, it recognizes that not all material items can be presented in the primary financial statements, as it would just be too detailed to be understandable. There's just not enough room. So a higher level of aggregation is required to provide a useful structured summary. Now, the role of the notes, on the other hand, is to provide material financial information, which is the necessary for investors to understand the items presented in the primary financial statements. But the notes are also needed to supplement primary financial statements with other financial information to achieve the objective of financial statements. Importantly, the role of the notes makes clear that if disaggregated information would be material, then this information is required to be disclosed in the notes. So moving on to the next slide. To help companies to judge how to group items to fulfill the roles of the primary financial statements and the notes, IFRS 18 provides general principles for aggregation and disaggregation. Now, a company aggregates items based on shared characteristics and disaggregates items based on characteristics that are not shared. A single dissimilar characteristic can, in some circumstances, be enough to require a disaggregation of an amount if the resulting information is material. However, keeping in mind that aggregation and disaggregation in financial statements should not obscure material information or reduce the understandability of the information presented or disclosed. IFRS 18 includes examples of characteristics for the statement of profit or loss and the statement of financial position that a company considers in making its judgments. Now, most of them are already referred to in other IFRS accounting standards, with a few additional characteristics that were identified as being important during the development of IFRS 18. So, for example, one of the characteristics a company would consider when aggregating and disaggregating income or expenses is persistence, including the frequency of the item of income or expense, or whether it is recurring or non-recurring. In addition to the guidance on when to aggregate and when to disaggregate, the standard also includes guidance to help companies to describe items presented or disclosed to represent them faithfully, including how to find more informative labels than, for example, other expenses. Now, if items for which information is not material are aggregated, the company shall consider whether the aggregated amount is sufficiently large that investors might question whether it includes items for which information would actually be material. And if so, the company provides further information about the amount. So this could be, for example, an explanation that no items for which information would be material are included in the amount, or an explanation that the amount comprises several items for which information would not be material, with an indication of the nature and amount of the largest item. And finally, on slide 39, IFRS 18 requires companies that present one or more operating expense line items by function to disclose the amounts of specified nature expenses included in each line item in the operating category of the statement of profit or loss. And the nature expenses required to be disclosed, as we can see here on the slide, are depreciation, amortization, employee benefits, as well as impairment losses of non-financial assets, so those within the scope of IAS 36, and write-down of inventories. Now, the amounts to be disclosed are not required to be amounts recognized as an expense in the reporting period. Instead, they are permitted to be the costs incurred, for example, employee costs, before considering amounts allocated to inventory. However, if the entity does disclose amounts that are not expense amounts, but it's rather recognized some of those amounts in the carrying amount of an asset, then the company needs to give a qualitative explanation of that fact and identify the assets involved. Now, on slide 40, we can see an illustration of what the disclosure requirement for specified expenses by nature might look like. In this illustration, the amounts disclosed are those recognized as an expense in the statement of profit or loss, except for depreciation and employee benefits. In this example, the amount disclosed for depreciation is the charge for the year applying IAS 16, and the amount disclosed for employee benefits is the cost incurred for employee services applying IAS 19. And as I just mentioned, because the entity is not disclosing expense amounts, it has to explain that the disclosed amounts of depreciation and employee benefits include amounts that have been capitalized by including them in the amount of inventory at the end of the reporting period. Hagit, could I now turn over to you for your thoughts on requirements for grouping of information?
Thank you, Juliana. So I think the package of requirements, so the requirements about aggregation and disaggregation together with the structure and subtotal, really provides a full pack for entities to perform their analysis and provide useful information. And I think we got good feedback generally on providing more guidance on disaggregation and aggregation. I think it provides clarity to the market, clarity in terms of how this guidance is being applied from a preparer point of view and also from an investor point of view. So a lot of the questions of what does other mean or what you've included here and there can be resolved when the guidance is clear. Having said that, this has not been an easy journey. There were a lot of topics that included in that package that took a lot of time for us to resolve. One example of this is the disclosure about by nature expenses when you have by function expense. And I think here we had to balance between a request for an investor that goes to the extent of a full matrix. We want to see whenever there is a by function expense, we want to see all the by nature. It's really useful for us to do our cash flow expectations. And from the other side, from the preparer point of view, at least I know the insurance industry a bit closer than the banks, but I can say the cost allocation model there are a heavy lifting in terms of working with them, and reverse engineering and extracting the information is not that easy. So we had to balance those concerns and those needs from both sides. And I think we got to a compromise that is a balance that is workable. So it's not all expenses, it's 5 types of expenses. And I think the other huge relief that we have is added flexibility that you need to, or you can disclose the by nature expense not only when it hits the P&L, you have an option to do it when it is actually recognized. So it is allowing, I think, companies some flexibility to work with the requirements in a way that work with their systems already. So I think at the end of the day, this is workable and will provide useful information at a balanced cost. Thank you for that.
Thank you, and I couldn't agree more with your comments that you really have made big efforts in listening to. I was part of some of the outreaches, and it was a lot of comments on the initial requirements with the kind of need for total reconciliations with book reported figures and so on. So I really appreciate all the efforts you have made in this area, and then we need to see on the endorsement process what EFRAG thinks. But me personally, I really appreciate all your efforts here. Massimo, could I have some views, reflections from your side? Thank you.
Yes, let's say on this section, I would put emphasis on the words already mentioned by Hagit, in the sense that for insurance industry, especially the topic of the detail by nature of specific cost is probably one of the area of complexity that you have to deal with the IFRS 18. For sure, there is already a requirement in the IS1 to detail the expenses by nature. However, now we need to make this reconciliation on the new representation of the expenses by function as required by the IFRS 17, and these new requirements to have this focus and this quantitative and partially qualitative reconciliation as required by IFRS 17 for some limited, but for sure important and significant for insurers class of cost. Here, of course, as remembered by Hagit, we recently already made significant changes on the allocation rules of the cost by nature, in the sense that IFRS 17 required a specific definition, even if principle-based, but a different definition compared to the previous reporting on how to allocate overheads and in general cost to the contracts, to the fulfillment cash flow, and to other operating expenses if they are not part of the service. And of course, these additional requirements would again require to have a sort of reconciliation between how the expense are attributed by function and the specific disclosure by nature. So it's, as we said, it's an area of complexity, for sure, on an area that has been already subject to transformation. And just from my side, I remind for all the insurance stakeholders that probably in terms of disclosure, this is an area we have to focus in advance, because would require some potential changes in the process, as well remapping, some reconciliation. So it's an area, of course, of cost for preparers, but for sure we acknowledge the global objective to provide consistent information to the users, to the analysts, to the investors on this area. But let's say heads up on the fact that these requirements is quite complex and will be quite costly, and so it requires planning and investments in order to provide quality on the disclosure requirements. That's my speech on this topic. Back to you, Niklas.
Thank you very much, Massimo. Lainey, do you agree with the previous speakers or any other views?
Yeah, generally I agree with the comments from Massimo. Yeah, so in terms of like the required disclosures of these additional expenses, it would be a challenge to assess right now, to make sure that we are able to provide this information. Although one welcome change that we have seen from the exposure draft to the final standard was that at least the presentation of the expenses by a mixed presentation of both nature and function is allowed without too much additional disclosures of all the expenses by nature. So I think that was actually one good thing that has come out of the final standard. But then, as mentioned already, these additional disclosures of these 5 specified expenses are would still pose some challenges as we go through the process. And actually, I have just a general question on this part, like why these 5 specific expenses? Like, why not others? Why not more? Why not less? Is just putting the question out there.
Thank you. Who want to comment on the last one? You're on mute, I think.
So, sorry, Nicholas, did you want us to respond to the question now? Okay. Slight connection issue there. So why the 5 items? A very good question. Limiting the requirement to the 5 items results in useful information to investors without causing undue cost per preparer. So we tried to find a cost-benefit balance that works both for preparers and end users. Now, depreciation, amortization, and employee benefits will likely be included in more than one functional line item in the statement of profit or loss. And disaggregated information about them is generally useful for understanding a company's business, regardless of its industries. So that's why these 3 items were in the scope. But equally, impairment losses of non-financial assets, so those within the scope of IAS 36 and write-downs of inventories, might also sometimes be included in more than one line item in the statement of profit or loss. So give users useful information on what's included in functional line items. But even if they're only included in a single line item, disclosing them in a single note together with the other 3 nature expenses would make information just more accessible for users. So that's the reason that we've decided to stick with the 5 items. Now, adding any more items would have just upset that cost-benefit balance that we've achieved with preparers and users.
Thank you. Nick, you have a comment as well?
Yeah, I just thought it was worth adding on that, we did consult. We had a period of targeted outreach around these proposals to make sure we're getting that right cost benefit balance, as Juliana's explained. And we did ask specifically, are there other specific items of expense that should be added to this? And because I think partly because these are sort of anchored in requirements that already exist today, but partly once you move away from this, you start getting very entity specific in which. So we did hear some messages, but it was more, a particular expense would be interesting for this industry, but isn't relevant across all industries. And then a part of the message was too, the more we add, the more cost that adds to the system for preparers. And so this was seen as that sort of balance in between getting enough specific information, but not challenging preparers too much. And as I say, partly because these are already requirements to some respect within IS1.
Thank you, Nick. Are there any other questions that you captured during this session, or should we move on to the questions from the audience? Silence speaks for itself. One question, I read it. If you present a P&L by nature, but we have some expenses by function, because we have to consider that we are then if we already have that mix, do we anyways need to give the specific disclosure requirements?
So the specific disclosure requirement for expenses by nature applies whenever you have one line item that is considered a functional line item. So the case you described, if you are already doing a mixed presentation, that would trigger that specific disclosure requirement, and then you would have to give this breakdown for all of the line items in the operating category. So not just the functional line items that you have, but disclose for all of the line items in the operating category of the statement of profit or loss, how much depreciation, amortization, employee benefits is included in those.
Thank you. Another question. Is it possible to disaggregate a line item required to be presented by an IFRS? And if so, can we aggregate one of these disaggregated items with another item and label it with another name? Do you capture that question? First you disaggregate and then you aggregate, but differently.
So first of all, the requirements in IFRS 18 do not change recognition and measurement requirements in IFRS accounting standards, such as IFRS 17. The principles of aggregation and disaggregation apply both to the primary financial statements as well as the notes. And in general, an entity would assess whether disaggregating specific line items in the P&L provides that useful structured summary that we've talked about of the company's income and expenses. So very likely in the primary financial statements, an entity will need to aggregate some items for which disaggregation would then be required in the notes, because the disaggregated information provides material information. I don't know, Hege, did you want to add something on this question?
Just to say that we need to be careful not to confuse disaggregation with decomposing of line items that was not meant to be by other standards. So the disaggregation and aggregation requirements do not overcome specific requirements in other standards that are specifically saying what a single line item should be. I know there is one requirement that we say that if there's another standard that requires a specific line item on the face of the P&L, you can apply your judgment, decide maybe it's not for you in terms of providing a useful structured summary, and then you disclose it at the notes. But it doesn't stretch as much as to disaggregating amounts that it would be inconsistent with recognition and measurement. So just need to think this through if you have any ideas of reflecting disaggregation and aggregation requirements differently.
Thank you. And one detailed question that I actually also asked myself and listening to you, when comparing slide 37 with slide 22, employee benefits is supposed to be disaggregated. In the disaggregation, do you include the net interest then on defined benefit liabilities, or is it just the employee benefits that are within operating ?
So the requirement is to disclose the amounts of employee benefits that are included in the operating category. So any amounts included in the financing category are not required to be included in that disclosure. The entity also gives the total amounts of employee benefits. So that would be the employee benefits comprising the amount of that you've recognized in accordance with IAS 19 and also the amount that you've recognized applying IFRS 2. Hopefully that's answered the question.
Yeah. Very clearly. Thank you. Then I think perhaps we already have answered that, but I will ask it anyways. Will the preparers have the option to present further subtotals within the designated categories to reflect better the specifics of their business model?
Yes, and Nick, could you possibly navigate to the slide where we actually have the statement of profit or loss, so we can just explain a little bit more clearly? I'll just wait till we get to the slide. Sorry, it's so far back in the deck.
You might want to start because it's a ways back. We'll get there. We'll get there.
We'll get there. Okay, so I think about 3 slides still to get back to. Sorry, okay, that's fine. Okay, so an example here, you can see gross profit. This is an additional subtotal that is shown in light gray on the slide. This is presented because it provides a useful structured summary, but it's not a required subtotal in IFRS 18. I think there's also statements of profit or loss showing in this slide deck, Nick, if we could navigate forward to the banks and insurers examples. We had net financial result was an example of an additional subtotal for an insurer, and net interest income was so we had net interest income and net fee and commission income are examples of 2 subtotals similar to gross profit that have been presented here because they provide useful structured summary for a bank. And then for the insurer, obviously we have insurance service result and net financial result, which are examples of 2 additional subtotals. Additionally, for example, a bank may put the credit impairment losses as the last item before operating profit, for example, and above that they could have operating profit before credit impairment losses as an additional subtotal if that would provide a useful structured summary of their income and expenses. So long as the subtotals fit within the structure, it is possible, and they provide a useful structured summary, it is possible to present them.
Thank you. And then it's really detailed questions on paragraph 103. So I just wonder if I read it up and see if you can make, I don't know the detail of that paragraph. In paragraph 103, present in balance a line item for goodwill out of intangible assets. The reason, does it have implications for the next amendments of IAS 38? So I don't know that paragraph by heart. Is it required to separate goodwill from other intangible assets, and then why?
So
I'm happy.
Ileana, sorry, go. You go.
Okay, so the IASB decided to add to the list of line items a requirement to present this separately. And the reason is that the characteristics of goodwill, the board finds, are sufficiently dissimilar to those of intangible assets to warrant its separate presentation. So, for example, goodwill is an unidentifiable asset, and it's measured only as a residual. It can't be measured directly. Hence, the board concluded these are sufficiently dissimilar characteristics to make it necessary to present it separately.
Thank you. Another question on paragraph 103, it seems to be an interesting one, is regarding non-controlling interest. Could you explain? I read it. An entity shall present in balance a non-controlling interest. Could you explain this modification? Does it mean the elimination of non-controlling interest within equity? I don't know if you understand the question, because I can't remember the paragraph.
If I understand, it means the separate as a separate line item. And so it doesn't mean eliminating it. It means it would, within that equity section, it would be a separate line item for non-controlling interest.
Okay.
And I believe it's paragraph 104 rather than paragraph 105, 103. But just to highlight, with useful structured summary, there are some requirements that the IASB has said always need to be presented because they provide a useful structured summary. And those are requirements that relate to the structure of the individual primary financial statements. And one of the items that you cannot use useful structured summary to override is this requirement to present those non-controlling interests. So that may be where the question is coming from. But yes, so they are required to be presented because they're part of the structure of the balance sheet.
Okay, thank you very much. Are there other comments, reflections on grouping and aggregation, disaggregation? Else, I think we can move on to the minor quotation mark things. It's the changes to the cash flow statement and the effective date and the transition requirements. Quite important stuff, that as well. Who will lead us from the IASB side?
That will be me, and okay. If we get that, so yeah, not minor but limited, let's say, for the statement of cash flow. So as you may be aware, IFRS 18 also introduces some changes to the statement of cash flows, although limited in the respect. And so today there is some under IAS 7 ability to make accounting policy choices around the classification of interests and dividends. IFRS 18, to get this along the same lines as the changes that I made in the statement of profit or loss to get more comparability, the IASB has included requirements that eliminate these policy choices. And so what we see on the slide is that for entities that do not have specified main business activities, the interests and dividends received will be classified as investing activities, and the interest and dividends paid as financing activities. And so that's no longer an option to include, sometimes in operating, sometimes in one of those other categories. Now, for those entities, which are probably most of who we're speaking with today, with specified main business activities, only the dividends paid remains as a financing activity. And then there's a policy choice, as we for the other cash flows, and it's to pick a single category for each of the investing, sort of the interest received, interest paid, or dividends received, to have a single category to keep a bit more comparability. The idea being there is that having that choice allows it to better align with the accounting policy choices that we have for the statement of profit or loss. Now, in explaining that, it's probably important to mention that there is not alignment between the classifications in the statement of cash flows and the statement of profit or loss. In the statement of cash flows, the descriptions of the activities, the definitions there have not been changed by IFRS 18. The only changes have been these changes to classification, and one more that I'll come on to in a minute. In the statement of profit or loss, obviously we've talked about where things are classified, and that doesn't always match up with how it is in the statement of cash flows. The board tried to keep alignment as much as possible, but where that didn't make sense, the objective of the use of the statement of profit or loss took precedence. And so we have some differences between where things will be classified between profit and loss and cash flow statement. Now, the other change that was made to the statement of cash flows was the starting point for the reconciliation of indirect cash flows. And so the starting point, whereas today it can be chosen, is now it will now be required to be the operating profit as the starting point for that reconciliation. And again, just to drive consistency between one statement of cash flow to another. So I'll move on then to the effective dates. So Florian mentioned at the beginning, the effective date is for periods on or after 1st of January 2027, with early adoption permitted. The standard will be required to be implemented retrospectively. And importantly, in the first period of adoption, the earliest comparative period will require to be reconciled from the previous presentation under IAS 1 to the revised presentation under IAS 18, as there can be significant changes there to give clarity of how that trend has moved. And I think that is as much as we wanted to go through today on those particular aspects, as you say, important, but relatively minor, at least in terms of scope. So I'll turn it back for any comments or questions in those sections.
Yeah, thank you very much, Nick. And please, audience, ask questions using Slido. But before we go to the question session, Anna, do you have some comments, reflections on these items?
Yes, thank you, Nicholas. In this last section, I would like to share some reflections on the effective date and the transition for the new standard. We believe that 1st January 2027 is a reasonable first-time application date. In general terms, we believe that it will allow companies enough time for an organized and robust implementation. However, as it has been mentioned during the educational session, both banking and insurance businesses are highly regulated industries, and we may force and face a more complex situation depending on the jurisdiction we operate, also whether we operate in different countries, and if local regulators and supervisors require us specific extractors for the financial statements, in particular for the statement of profit and loss, or indeed whether these supervisors and regulators, they may limit the accounting policies choices that they have been included in IFRS 18. So having the view of the local regulators and supervisors as soon as possible, it will make easier all the changes that we need to implement in our IT systems. I believe it was Hajid that mentioned that for some companies, it can be a challenge, some of the requirements for derivatives, also for the hybrid contracts. This, the complexity will depend a lot on the type of company that is implementing the standard. For us, the best situation will be to have similar structures for standalone and consolidated financial statements, because if we need to implement different structures, it will increase the implementation initial cost, but also all the subsequent maintenance that all the systems will need. Also, we need to consider that the implementation may be more difficult or not, depending on how companies and Big Four audit firms understand certain requirements in the standard, in particular, those requirements that it could be gray areas. And in this context, today's educational session is very useful for preparers. Just two last comments. The first is that some preparers may also want to align as much as possible their structure of the statement of profit and loss in order to provide this useful summary structure that IFRS 18 is built on. And because maybe the management view of these companies believe that aligning with some management view is more useful for users. And maybe such changes may be more complex to implement for some companies. And my last comment was regarding the comparatives. As Nick was explaining, we will need to provide comparative information. In the case of our group, we provide 2 years of comparative information. So we will need to restate 2 full years. And although the date of 1st January 2027 may seem that it's very far away, the need to restate the years 2026 and 2025 and in the interim financial statements means that we can not lose any time, and we believe that it's essential to start preparing now to meet all the deadlines, to understand completely the standard and begin the implementation. Back to you, Nicholas.
Thanks a lot, Anna. I saw that Ricardo wanted to comment.
Yes, Nicholas, just wanted to echo what my colleague Anna has said. Totally agree with her. And I understand and I appreciate that the ASB there's very little that you can do with our regulators and to set up a final format of our P&Ls or primary financial statements. But it is what it is, and obviously the implementation of this standard will be largely affected by the impact of our regulators, as Hannah just mentioned. So I think the only thing we can ask from you is, and this is probably more for EFRAG than for the ASB, is to speed up the endorsement process. Right now, the sooner the better, because that's when regulators will feel the pressure to start aligning with this new standard, taking the decisions as whether they are going to modify also supervisory financial reporting. Unlikely, but it may happen. But generally, if a standard is endorsed by the European Union, local jurisdictions need to that, or the accounting frameworks to that. And obviously that speeds up the process. So thank you very much for your...
Yeah, thank you, Ricardo. Massimo, any reflections from your side?
Yes, but let's say I would like to echo what Anna and Ricardo already said. Probably in the insurance industry, on the topic of the format of profit or loss, the situation is most fragmented. So there are jurisdictions where the regulator mandate a specific format, other jurisdictions where it is not. And so, of course, this creates additional issues on timing for some preparers rather than others. But I guess that the interaction of this standard with the regulation is a key area of concern that we need to have considering the time of implementation. I agree the 1st January 2027 is a good date in terms of plan our activities, but it is not so long, as Anna said, because of course there are comparatives to be restated and regulators to be dealt with on this. Maybe on transition, I would like to remind, of course, under the control of the IASB, the fact that to alleviate the topic of the associates, there will be the possibility to apply the fair value option of IAS 28 in order to mitigate a bit the points on the classification, because in that case, the fair value changes of associates would flow in the operating activities. And so this is an important point that they need to be highlighted. Lastly, maybe, and this is also a question, is related to cash flow statement. I guess that the proposed changes are not sufficient to increase the quality and the relevance of the cash flow statement for financial institutions, I guess both for insurance sector and banking sector. So I guess it's important to have a feeling of what is the current planning under cash flow statement. That's all from my side.
Thanks a lot, Massimo. Any comments from the IASB on the questions raised by my fellow banking and insurance colleagues?
Sure. Let me say a few words about the cash flow statement for banks and insurances. As a long-term banks and insurance analyst, I know of the difficulties of using the cash flow statement. We have heard that the cash flow statement, as much as the income statement, is derived of a reasonably old profit standard. So as part of our last agenda consultation, we were given the task to start a cash flow project. That is on our list, and that is actually fairly high on the list. And I would expect that to be tackled soonish without committing to anything here. But one of the topics we will be discussing is if we want to have a separate cash flow statement for financial institutions, and if we should have it be presented in a different structure. So, we hear you, and we'll come back to that question in the near future. Katrin, you want to add to that?
Yes, EFRAG is working at the moment on a discussion paper as well for cash flow reporting, and that we expect to publish it in autumn. It will cover as well the cash flow reporting for financial institutions. This was one of the hot topics in our outreach. We organized in last autumn roundtables to discuss the need for cash flow reporting and what the objective of cash flow reporting could be. Are there any alternative for cash flow reporting? And so we support the IASB research project by preparing it with a discussion paper. That's what I wanted to mention. Thank you.
Thank you. We have some questions from the audience, and it's several ones on the kind of rule regarding the placement of dividends. It's several ones, but could you comment on why you choose to be so harsh or hard here and require a certain placement, even though the dividends may be received for a lot of different purposes? For instance, it may be integrated associates or similar businesses with less ownership that give you that dividend. That's a payback for expenses you have made to them and so on. Just a comment. Why did you make this choice? What's the reason? Thank you.
So I think this probably parallels to our associates and joint ventures, and the fact being that it's recognized that there's potentially different purposes. There are different views about how these cash flows are seen, but investors face similar challenges as when there's choices, being able to find the relevant information and being able to compare from one entity to another. So what was given precedence by the board in this case was to have a single location for the cash flows to make it easier to find and easier to compare. And once that's happened, users can decide whether they think it's more appropriately, how it more appropriately fits into their analysis, but having a single location was seen as the most important thing in trying to get more comparability.
Thank you. Moving on to some other questions. It's no more questions on this item on the agenda, but we have some old questions, quotation mark, that were not addressed before. And one is, in which section the deconsolidation result due to sale of a subsidiary should be recognized?
Okay, so I can take that one. And generally, the gain or loss on deconsolidation of a subsidiary would be reflected in the operating category. However, there could be a situation where you, for example, house investment property in a separate subsidiary, and the income and expenses from that investment property have been classified in the investing category. So in a situation where the subsidiary only contains assets that relate to the investing category, the gain or loss on deconsolidation of that subsidiary would be classified in the investing category, but otherwise it would be classified in the operating category.
Thank you. Very clear. And here, is it true that all associates joint ventures that are at fair value through P&L should go to the operating category? IFRS 18 appears to allow only those integral to the main business activity. So it's a question.
Okay, so just to clarify first and foremost that if it's equity method, it will be in the investing category, and that is not subject to any assessment of main business activities. However, if you're using fair value method, so in particular paragraphs 18 and 19 of IAS 28, they would be subject to the assessment of whether they are investments as a main business activity. Generally, entities that can apply those two paragraphs in IAS 28 are venture capital organizations, mutual funds, and similar types of entities. And generally, for those types of entities, we'd expect the conclusion would be that they are investments as a main business activity. In particular, the interaction between the investment entity requirements in IFRS 10, if you actually have associates in joint ventures, you're required to apply those paragraphs and to fair value any associates in joint ventures that you have in order to meet the requirements to be an investment entity. So for an investment entity, we'd expect that the conclusion would be that they would be classified in the operating category. Also, in your separate financial statements, you can either measure your associates in joint ventures and even subsidiaries actually at cost or fair value, and similar to what happens in consolidated accounts with those paragraphs I just mentioned in IAS 28, they would also be subject to the assessment of whether or not they are investments as a main business activity. For example, a holding company that has subsidiaries at cost or fair value, we would expect would reach the conclusion that they are investments as main business activity and take those income and expenses into operating category.
Perfect. Thank you. Another question.
Sorry, just again on this one. Yeah. The differentiation here is not the question, is it investing or operating? The differentiation here is the measurement method, right? It was the measurement method, which was the reason why we took it out of operating. Not really the discussion, is it really investing or operating? Thank you.
Thanks. Another question, is there any change to IAS 1 option to disregard disclosure of immaterial items? And quite a related one that I think that Martin was into, if you just have really immaterial items outside of operating, could you then move them into operating, ?
Okay, so IFRS accounting standards, there's absolutely no change in that they do not apply to immaterial items. So the requirements for materiality in IAS 1 today have been carried forward without any change. So anything immaterial is not required to be presented or disclosed.
Thank you. And then another question, has the IASB considered connectivity between IFRS 18 and management performance measures and revenue-based metrics in IFRS S1 and S2?
Well, so thanks for that question. So really appreciate that somebody is interested on our sister board's publication. I think, and then I think it's an interesting one. I think the issue is we haven't seen any S1, S2 disclosures yet. So we'll see what happens. I think our general expectation would be, so let's start out with, we work very closely with the technical staff and our colleagues on the IASB to ensure that there's a general alignment between the different standards, right? And we do have very regular exchanges with them. On the specific issue raised here, I think there's a general expectation that most of the key metrics which are supposed to be disclosed under S1 would not be financial statement line items. I mean, I'm happy to be surprised otherwise, but we would not expect that to be the case. I think if you then go, I think it's paragraph 29D in S1, where you then talk about the impact on the financial position of the company. This is where you, I think, get more in the overlap between S1 and the financial statements. So at this point, we wouldn't expect it, but it will be really interesting to see if that happens. But at this point, I would think the key metrics, even revenue based, would not be at the presentation level, but probably only further down in the notes section. Good, yeah. Thank you.
Thank you. Then we have time for one question more, I think. If the result from our associates is insignificant, do we have still to show it separately? And I guess it's already answered in one respect, but not, it's more detailed than pinning you down to answer the detailed question. Could you disregard things that are outside of operating and put them into operating is really the question in one respect.
So how I read the question that came through from Slido was, if something is insignificant, does it have to be presented as a separate line item? So obviously share of profit or loss of associates and joint ventures is one of the line items listed for presentation in IFRS 18. However, the concept of useful structured summary would come into play, and it would only be presented if that presentation is necessary to provide a useful structured summary. If it's not, it does not need to be separately presented, but if the amount is material, it would need to be disclosed in the notes. And as I mentioned before, anything that is immaterial is not required to apply IFRS accounting standards to immaterial items.
Thank you. One more, I think, we have time for. Where are the biggest efforts expected for insurers and banks when implementing IFRS 18? Mapping, systems, processes, other? I guess that's a question to the panel members. Anyone that want to comment?
Well, I can take, everyone, I can take that one. From my perspective, the biggest issue we're going to have is juggling between this standard and the different requirements that we're going to receive from different jurisdictions. And then we'll have to take on the board the view of the supervisor. Hopefully they won't make any changes to current supervisory reporting. And then on top of that is essentially agreeing all those blocks and mapping our ledger into a new format of a financial statement. Here is more a timing issue than anything else. It's basically having time to properly analyze your P&L and mapping this item to the new categories and ensuring that you are aligned with everything we have to comply with.
Thank you, Ricardo. Anyone that wants to comment? No other comments? Then
I can add on as well.
Yeah, please.
Yeah, hi. So I think for us, it will also be like the mapping changes and considering if we need to have changes to our chart of accounts, for example. So where we have this kind of changes required, we then also need to consider the timing, because for us as a large organization, we have also certain processes in place to make sure we have adequate time to address changes. So we have you can say like a very structured process to go through this entire process to make any changes to our systems. So I think in that sense, the timing is actually kind of critical. On the other hand, of course, we also would want to have the same timing for when the standard takes place as well for not just the EU but also for the rest of the world, so that the timing is aligned and we don't have differences in the application of the standard to all the entities. So I think this is one thing that we are truly considering, and so we'll certainly be looking at it as soon as we can.
Thank you a lot. Then it's time for us to conclude. Catherine, could you present your main takeaways from today's session, please?
Yeah, thank you very much, Niklas. It was today, again, an intensive discussion that similar as we have experienced during the outreaches and the field testing. So I must say that the IASB was during the consultation phase and redeliberation phase very open for receiving feedback, and I think that might have as well had impact on the final result. So at the moment, as I said, we have received from the European Commission an endorsement request which does not address any additional issues. We pre-discussed in the FRB whether there are any blocking factors for the endorsement, and nothing was identified. We know that there are critical points. We have listened to your critical points today. So we are well aware and we will address them in the endorsement advice, but none of it is considered being a blocking factor for the endorsement in Europe. So, and we have understood that there is the pressure on being fast for the endorsement process. So we will try to be as fast as possible and assess the endorsement criteria within this year and send the endorsement advice, the draft endorsement advice out for public consultation. We have to respect a bit that there is the busy season ongoing, so we will end with the consultation process after the busy season and not in the middle of the busy season to allow to receive sufficient feedback for the endorsement process. What we have seen today is that we have several topics related to the classification of items. So there is a bigger issue for the insurance industry and for the banking industry to present the result from associates and joint ventures in the investing category. Nevertheless, the IASB has explained that they mitigated it by allowing a subtotal that does not require the MPM disclosures. And the IASB explained again its reasoning for showing it or for requests. We have no specific requirements for banks and the insurance industry. So with that, we know that this is a critical factor. We have seen as well that interest expense is an issue and that they are presented in the financing category. This has impact as well on the insurance industry, that you might have to strike out part of these out of the normal insurance expense. So that is something that will be costly for the insurance industry. The conglomerate topic was intensively discussed, and thank you to the IASB for explaining it in more detail. Hybrid contracts might be complex to classify, and we have seen the flowchart of the IASB, but still that is something to follow up and to address early. We have heard as well that for banks, the operating profit that might include nearly everything. And for Martin Svitek addressed it that for him it's not understandable that a few items have to be taken out. because of IFRS 18 requirements. Nevertheless, the IASB has made clear that they do not want to have specific requirements for an industry. They want to have a principle-based standard. So that's really understood. So classification and subtotals is the hot topic for the industry. For MPM, we could hear that this was considered being a good compromise, what was reached. The non-controlling interest reconciliation might still be challenging. And the simplifications for tax reconciliation was highly appreciated and similar the rebuttable presumption. And we know that the banks are well prepared for reconciliations, and they have to do it already regularly for regulatory purposes. And in this regard, we were reminded by Ricardo to the interaction with the regulators, and that there has to be some kind of reaction from the regulator side as well on the IFRS 18 requirements, and that this could be helpful process to be started early when the endorsement is done. For aggregation and disaggregation, we heard from the insurance industry that there are issues for them for the reconciliation by function. When you present by function, that you have to present certain items by nature. Nevertheless, in general, the guidance for aggregation and disaggregation is appreciated, that there is additional guidance out that makes it clear when it is necessary to disaggregate. And as well for mixed presentation, that this is allowed. I think that was considered being a big relief. And questions have clarified that even mixed presentation might need, there you might need the reconciliation to by nature. So I think that as well the explanation about the additional subtotals was helpful in this regard. And for the transition, we had heard from Anna Vidal a plea to get started, because there are several issues to be addressed. And she made certain examples why such transition should be started soon, to adapt the processes and to classify the hybrid contracts properly, to follow the instructions for the useful structured summary. And she reminded us that some of the preparers have 2 years of comparatives to prepare, which might be challenging. So there's a challenging timeline. And with cash flow, we have received certain requests, and it was from the IASB announced that the cash flow project will start soon, and that there is some development to be expected for the cash flow reporting as well.
Well,
And,
we didn't commit to start it soon, but it's on our list, and we'll, when the board decides, we'll get to it before the next agenda consultation. That's what we're committed.
Okay, good.
But you know what we're talking about, right?
Yes. I would like to use the chance to say thank you to all the panelists for the intensive and good discussions. It's very helpful to receive this feedback and to help that to understand the standard is a good basis for an endorsement process and for the implementation. So I think the endorsement process is on a very good way. So I can just repeat what Ricardo was saying as well, and Anna Vidal, maybe try just to get started with your implementation sooner than later. And I would like to say thank you as well to my team who has helped to run this event. So thank you.
Thank you, Katrina, and we are perfect on time finally. So it's time for me to end this meeting. A big thank you for the audience that were very active and really good questions to us, and thank you for the panel that were sharing its remarks. And finally, a big thank you to the IASB, not only for this event, but for the whole process. I think this is a very good example for the IASB to follow in other projects. There have been a lot of different opportunities for all stakeholders to interact with you, and you also have listened and made changes from the ED to the final standard, and it shows that you have listened in a really good way, I think. Everyone cannot have all their wishes come true, but still you have made a lot of good efforts, and I really thank you for that. So thank you, everyone, and goodbye.
Thank you. Bye-bye.
Thank you very much.
Bye.
Goodbye.
Bye.
Goodbye.